Dividend investing is a tried and true strategy for building long-term wealth, and at the heart of its appeal is the concept of the dividend snowball. This powerful compounding effect turns small investments into a massive income-generating machine over time. Like a snowball rolling down a hill, which starts small and grows larger with every rotation, dividend investing grows wealth steadily and then exponentially, creating financial security and independence. This process requires patience and discipline, but the rewards can be extraordinary. Understanding how the dividend snowball works, why it is so effective, and how to harness its potential can change the way you approach investing and wealth creation. The process begins with the simple act of investing in dividend-paying stocks. These stocks represent companies that distribute a portion of their profits to shareholders regularly, typically quarterly. At first, the income generated from these dividends may seem modest. For example, a $10,000 investment in a company with a 3% annual dividend yield produces $300 in the first year. It's not a life-changing amount, but it's the first roll of the snowball, small yet significant, because it sets the stage for growth. The real power of dividend investing comes when you reinvest those dividends rather than spending them. Using the $300 in dividends from the first year to purchase additional shares of the same stock increases the number of shares you own. These new shares, in turn, generate their own dividends, which are reinvested to buy even more shares. This cycle creates a self-reinforcing loop. Each dividend payment grows larger because it is based on a growing number of shares, and each reinvestment accelerates the process by increasing the income-generating base of the portfolio. While the initial growth may feel slow, the dividend snowball begins to pick up speed as time goes on. Early in the process, the increase in dividend income might seem incremental. If your $10,000 investment grows to $10,300 in the first year, the next year's dividends might generate slightly more than $300, perhaps $310 or $315, depending on how much the reinvested dividends added to your holdings. This slight increase may seem inconsequential in the short term, but over the years, as the reinvestment cycle continues, these small gains compound into substantial growth. One of the key factors that makes the dividend snowball so powerful is the role of dividend growth. Many high-quality dividend-paying companies have a history of increasing their payouts annually. This means that even if you don't reinvest your dividends, the income you receive from your original investment will grow over time. For example, if a company increases its dividend by 5% each year, your $300 in annual dividends from the first year will grow to $315 in the second year, $330 in the third year, and so on. When combined with reinvestment, this compounding effect accelerates the growth of your portfolio and income stream exponentially. Time is the most critical ingredient in the dividend snowball success. In the early years, the growth may seem slow and unspectacular, but as the years pass, the compounding effect begins to take on a life of its own. Let's revisit the $10,000 investment example. With a 3% yield and annual dividend reinvestment, your portfolio might generate around $400 in dividends by year 5. By year 10, that figure could rise to $600 or more. And by year 20, the annual dividends could easily exceed $1,000. This is the essence of the snowball effect. As the dividends grow, they create more dividends, and the cycle accelerates. After a few decades, what began as a trickle of income becomes a torrent. The beauty of the dividend snowball is that it doesn't require constant oversight or additional investments to succeed. While reinvesting dividends is a key part of the strategy, the process itself is largely automated in most brokerage accounts, requiring minimal effort from the investor. Unlike other investment strategies that may rely on timing the market or frequent trading, dividend investing allows you to focus on the long-term growth of your portfolio without worrying about short-term volatility. Another advantage of the dividend snowball is that it works in tandem with capital appreciation. Many dividend-paying companies are well-established, financially stable businesses that experience steady stock price growth over time. As their share prices rise, the value of your portfolio increases, even as it continues to generate growing dividends. This dual benefit of income and growth makes dividend investing a powerful wealth-building tool, particularly for those with a long-term perspective. The dividend snowball can also serve as a foundation for financial independence. Over time, the income generated by your portfolio can grow to a level where it covers your monthly expenses, freeing you from the need to rely on a paycheck. At this point, you can choose to stop reinvesting dividends and use them as a source of of passive income. What's more, many dividend-paying companies continue to increase their payouts annually, meaning your income will likely continue to grow even if you're no longer reinvesting. This makes the dividend snowball not just a tool for building wealth, but also a strategy for maintaining financial security in retirement. Of course, not all dividend stocks are created equal, and choosing the right ones is critical to the success of the dividend snowball. The best candidates are companies with a history of consistent dividend payments and increases, such as dividend aristocrats, firms that have raised their dividends for at least 25 consecutive years. These companies often operate in stable, predictable industries, such as utilities, consumer staples, and healthcare. Their reliability ensures that the snowball continues to roll, even during periods of economic uncertainty. The dividend snowball also rewards patience and discipline. Unlike get-rich-quick schemes or speculative investments, dividend investing is a long-term strategy that requires time to reach its full potential. Early on, the gains may seem modest, but as the years go by, the compounding effect becomes exponential. Investors who stick with the strategy, reinvest their dividends, and allow time to work its magic are rewarded with a portfolio that generates ever-increasing income and growth. In addition to selecting the right stocks, it's important to remain consistent in your approach. Regularly adding to your portfolio, even in small amounts, can accelerate the snowball effect. For example, contributing an additional $100 or $200 per month to your investments not only increases the base of your portfolio, but also amplifies the compounding effect of reinvested dividends and dividend growth. Over time, these incremental contributions can make a significant difference in the size and speed of your snowball. If you were to invest $10,000 at a 4% annual dividend yield and reinvest all dividends while also benefiting from an additional 7% annual stock appreciation, the results after 20 years would be extraordinary. The initial investment would grow to approximately $84,789, with a significant portion of that growth driven by the compounding effect of reinvested dividends. Over the 20 years, you would have reinvested about $26,521 in dividends, which further contributed to the overall portfolio growth. Here's how it works. Each year, the 4% dividend yield generates income based on the portfolio's growing value, thanks to both reinvestment and stock appreciation. For instance, in the first year, you'd earn $400 in dividends on the initial $10,000. By reinvesting that income, you would increase the number of shares you own, which in turn would increase the dividends paid in the following year. This process compounds as the portfolio appreciates by 7% annually, resulting in a higher base for both dividend payments and capital growth. The power of reinvested dividends becomes particularly evident as the years progress. Early on, the growth may feel incremental, but as dividends compound and the underlying value of the portfolio appreciates, the growth becomes exponential. By the end of the 20 years, your portfolio would have grown over eightfold, demonstrating the remarkable synergy between dividend reinvestment and stock appreciation. This example illustrates the transformative potential of combining dividend investing with a long-term perspective and steady market appreciation. Even a relatively modest initial investment of $10,000 can turn into a substantial portfolio over time, thanks to the compounding effects of reinvested income and market growth. For investors seeking to maximize the benefits of dividend investing, tax-advantaged accounts like Roth IRAs, traditional IRAs, and 401ks offer additional opportunities. In these accounts, dividends can grow tax-free or tax-deferred, depending on the account type. In a Roth IRA, for instance, qualified dividends are not subject to taxes at all, allowing the full power of compounding to work without interruption.